Hello, this is a recording on the module FIN2601. In the previous class, there's some homework that I asked you to look at on the module FIN2601. As you might remember, to date we've been going through the module and we've been looking at the study units, and to date we have covered the following study units. We've looked at an introduction, study unit 1, the role and environment of managerial finance, just a brief intro. We've looked at financial statement analysis, and we've looked at time value of money. In this session, I'm going to take you through interest rates and bond valuation. Then in the next session, I'll take you through risk and return, and we'll finish up with share valuation. Okay, so let's go through that. So in the previous recording, I asked you to look at some selected questions from May, June 2019, in particular questions 17, 21, 23, and 24. So let's just go through those briefly, and then when we're done going through those, I will take you through interest rates and bond valuation. So from May, June 2019, I asked you to look at question 17. It was a time value of money question. We were told Kylie is considering a project which will provide her with annual cash inflows of 4,098, 4,130, 4,545 at the end of each of the next 3 years respectively. What is the current value of these cash flows given an 8% discount rate? So in this case, you need to use your financial calculator, right? You need to use your financial calculator to enter in these cash flows. So remember, we've been told that these cash flows are occurring at the end of each year. So it means CF0 will be 0. CF0 will be 0, right? So that's important. So we can take our financial calculator. We always clear it first. That's important. Make sure that you clear it. Your calculator should be on 1 PYR. And then we enter in each of our cash flows. 0 firstly, then 4,098 cash flow, 4,130 cash flow, 4,545 cash flow, and then we enter in a discount rate of 8%, let's shift button NPV. So we get 10,943.22, which is option 2. So that's the present value of these cash flows, and the calculation is up here. Okay, so you would use your financial calculator. Question 21 was the next one that I asked you to look at. Question 21 says the Zuri family takes out an 8,000 Rand mortgage from the bank to buy a new home. The bank charges interest at an annual rate of 14% compounded monthly over 20 years. How much on the loan will the family still owe at the end of the first year? Now, this is an amortization question. It's an amortization question. And remember, we said when we're dealing with an amortization question, we start by calculating the PMT. And then from the PMT, we then calculate whatever we've been asked to calculate, whether it's the balance on the loan, the part of the loan that goes to the interest payment, or the part of the loan that goes to the principal payment. Okay, so firstly, we start by calculating our PMT, right? We put in 8,000 as a negative, that's the loan, 14% divided by 12, because the interest is compounded monthly. 20 by 12, interest is compounded monthly, 20 by 12 will give us N, and then we get our PMT, and our financial calculator will give us the balance. So let me just illustrate to you how we would go about that using an HP calculator. We put 800,000 as a negative. That's our PV. 14 divided by 12. That's our interest. 20 by 12. That's our N. And then we calculate PMT. Okay. Now we want to know what happens after 1 year. Let me just put up the question. The question is asking us what will be the outstanding balance at the end of the first year. So this family is paying monthly payments. So at the end of the first year, they will have made 12 payments. Okay. So because they're making monthly payments, it means at the end of the first year, they would have made 12 payments. So we want to find out how much of the loan will be outstanding after 12 payments. Okay. So to do that, to find out how much will be outstanding after 12 payments, we simply press 12, right? And then we press the red shift button, and then we come to amortize. Sorry, let's say 12, input, shift, amortize. Yeah, there we go. Okay, I'll just show you that again. We say 12, input, shift, amortize, and then it takes us straight to 12, 12. And then we can press equal to. So I actually have to start the calculation again from the beginning, just to put the calculator to the right mode. I'll just put up the question again so that I can enter in the numbers. Okay, these are the numbers. Let's re-enter. We say 800,000. That's our PV. 14 divided by 12. That's our interest. 20 by 12. That's our N, PMT, right? We say 12, input, redshift, amortize, equal to, of the PMT we just calculated, 698 is going to the principal, 9,249 is going to interest, and the balance on the loan is 792,129.62. Yeah, 792,129.67. Okay, I actually wrote the incorrect item here. I'll fix that. Okay, so if we do that calculation, we get the outstanding amount of 792,129.67, which is option 3. So that will be the outstanding balance at the end of the first year after 12 payments have been made. Question 22 says, let me see, what's that? No, the next question was question 23. Part of the questions I asked you to look at. What is the effective interest rate earned on an investment if the nominal interest rate is 15% per annum, but the interest is compounded twice a year? Remember, we said we use the effective rate formula where we say 1 plus our interest over 2, close bracket, to the power of 2. We're saying 2 here because the rate is compounded twice a year. It's compounded semi-annual. And then we always say times 1, and then we can calculate this. We actually didn't have to put the 1. We could just have said I over 2 to the power 2 minus 1, and then we simplify, and that gives us our effective rate. Remember, if it was quarterly, it would be I over 4, and it would be to the power 4 year. If it was monthly, it would be to the power 12 year, and here we would divide by 12. So you can use your scientific calculator. Some students struggle with finding the power button, so I'll just also redo this calculation up on the screen. In this case, it will be open bracket 1 plus 15% divided by 2 to the power of 2, right? Minus 1, and we get 15.56%. which we can write as a percentage. Okay, right. So that gives us option 3 from the solutions. And then lastly, for your homework, I ask you to look at question 24. Question 24 says Rector Limited established a trust fund that provides 90,000 Rand in scholarship each year for needy students. The trust fund earns a 6% interest rate. How much money did the company contribute to the fund if only the interest income is distributed? How much money did the company contribute to the fund if only the interest income is distributed? Now, remember, I gave you the following formula in the previous class, where we said if we are dealing with what we call a perpetuity, where you're receiving money for an indefinite amount of time, we said to get the present value, we just take the payment divided by the interest. So in this case, they gave us the payment, which is the amount being paid, and they gave us the interest, and they wanted us to determine the present value. How much in total had been contributed to the fund, because the fund provides an annuity of 90,000 Rand each year and is being received indefinitely. There's no time here. So we just say 90,000 Rand divided by 6%, 90,000 over 0.06, and that gives us 1.5 million. So this is an annuity in which the present value of the perpetual annuity of the perpetuity is 1.5 and the interest is 6%, and you're receiving 90,000 Rand each year. Okay. So those are the questions I asked you to look at as homework. I hope you were able to do them. So I now want to move on and continue by looking at the next study unit, study unit 5, interest rate and bond valuation. The study unit also involves a lot of use of the financial calculator, so I'm going to take you through that and how to use a financial calculator to determine the price of a bond, right? Remember, a bond is just a loan. A bond is a loan, okay? So the idea behind a bond is that a company borrows, and then they agree to pay interest on the money that they borrowed. So a company will borrow, and then they'll agree to pay interest, and the interest that the company pays is known as a coupon payment. So a company will pay interest on a bond known as a coupon payment, and then after a certain number of years, they'll pay back the money that they borrowed. But I'm going to take you through that and what bonds are and everything. But the first thing I want to talk about, I want to talk about what we call a yield curve. We have what we call a yield curve. A yield curve is simply a graph that shows the cost of borrowing money for different maturities. Okay, it's simply a graph that shows the cost of borrowing money for different maturities. For example, the yield curve might show us that if you borrow money for 5 years, you pay a certain amount of interest. If you borrow money for 10 years, you pay a certain amount of interest, and so forth. So maybe let me just illustrate to you what we mean by yield. I can also rather illustrate the yield curve using these notes that I've put up. Remember, I've said that a yield curve is just a curve that shows the cost of borrowing money for different maturities. So I can illustrate that to you through some examples. For example, this one going up can be an example of a yield curve. It's known as an upward sloping yield curve. And you might find that for a term of 2 years, right, the cost of borrowing money might be 10%. That's the yield, right? And then for a term of, let's say, 10 years, you might find that the cost of borrowing money is 20% interest per year. So that's what a yield curve does. It just shows you term on the horizontal axis and the cost of borrowing money for different maturities on the vertical axis. So we call that a yield curve. It's just a diagram that shows the cost of borrowing money for different maturities. It's also known as the term structure of interest rates. It's known as the term structure of interest rates. So yield curves have different shapes. You can have a yield curve that's upward sloping. You can have, that means the cost of borrowing money in the future for longer terms is more expensive than the cost of borrowing money for shorter terms. Meaning if you want to borrow money for 20 years, it will be more expensive than for a year. And then you can also have a downward sloping yield curve. That means if you borrow money for a longer time, it's cheaper than borrowing money for a short time. And then you can also have a flat yield curve. This means the cost of borrowing money is the same at every maturity. So there are three important theories we can use to explain the shape of a yield curve. So if you see a certain shape in a yield curve, there are three theories we can use to explain the shape of a yield curve, right? So I'm going to take you through these theories before we look at bond valuation involved in our financial calculator. The first theory we can use to explain the shape of a yield curve is known as the pure expectations theory. Okay, so this theory, known as the pure expectations theory, can be used to explain the shape of three yield curves. So the pure expectations theory can be used to explain the shape of three yield curves, right? It can be used to explain the shape of an upward sloping yield curve, a downward sloping yield curve, and a flat yield curve. The theory says that the shape of a yield curve is based on investors' expectations of future short-term interest rates. So the theory says that the shape of this yield curve tells us what investors expect with regards to short-term interest rates. An upward sloping yield curve, meaning if our yield curve is going up, an upward sloping yield curve means that investors expect future short-term interest rates to rise. A downward sloping yield curve means that investors expect future short-term interest rates to fall, and then a flat yield curve means that investors expect future short-term interest rates to remain the same. So it's a common question to come in the exam, whereby you are asked to explain a shape of a yield curve based on the pure expectations theory, right? And then the next theory that we can use to explain the shape of a yield curve is known as the liquidity preference theory. The liquidity preference theory. And this theory can be used to explain an upward sloping yield curve. The liquidity preference theory can be used to explain an upward sloping yield curve. And this theory says that investors prefer short-term bonds to long-term bonds, meaning investors prefer liquidity. Short-term bonds have more liquidity than long-term bonds. So this theory says investors prefer short-term bonds to long-term bonds, and they require a liquidity premium for investing in long-term bonds, meaning the interest you get charged for investing in long-term bonds will be more than short-term bonds. And then lastly, we have the market segmentation theory. This theory can be used to explain the shape of any yield curve, right? Market segmentation theory is the third theory. This one can be used to explain the shape of any yield curve. It can explain an upward sloping yield curve, downward sloping flat yield curve, and even what we call a humped yield curve. A yield curve like this is known as a humped yield curve, and we can use market segmentation to explain the shape of a humped yield curve. This theory says that the yields to maturity is determined by supply and demand at that particular maturity. So with market segmentation, we're saying the shape of a yield curve, meaning the cost of borrowing money for different maturities is only affected by supply and demand, nothing else at any particular maturity. So for example, if investors demand medium-term securities compared to short-term and long-term securities, our yield curve will be humped. So you'll see the yield curve will be higher in the middle terms compared to the shorter terms and longer terms. If investors are preferring medium-term securities compared to short-term and long-term securities. That's according to market segmentation theory. So market segmentation theory can also be used to explain a yield curve going up. Because it's higher for longer maturities, it would mean that investors are demanding longer maturities compared to shorter maturities. If it's downward sloping, it would mean investors are demanding shorter maturities compared to longer maturities. If it's flat, it means that investors are demanding all maturities the same. So you need to be able to briefly explain these three theories. They come up a lot in the exam, and they've also come before in the long section where you have to write out, and they come with a lot of marks and you're asked to explain them. So make sure you're comfortable with those three theories that can be used to explain the shape of a yield curve, right? Market segmentation theory, expectations theory, and liquidity preference theory. They are very important. Okay, so next we now want to look at bond valuation. We want to look at bond valuation. This is where we now look at determining the price of a bond. Okay, so firstly, you need to note that a company, let's say a company wants finance, long-term finance, money to use in capital projects, meaning money to use in projects where they only expect to start receiving money from the project after more than 1 year. The company can raise money from two sources. The company can either raise money from bonds, meaning debt, which is borrowing, or they can raise money from ordinary shares. And we'll also look at ordinary shares later on, right? So this bond that we've been talking about so far, when we were saying the term structure of interest rates or a yield curve just shows the cost of borrowing money for different years. This bond is just another name for a long-term loan. A bond is simply a long-term loan. And what happens with the bond is that borrowers receive a sum of money from the investor. So meaning a company will receive a sum of money from an investor, and the company, who is the borrower, will agree to pay interest payments, and these interest payments are known as coupons. So the borrower, who is the company, receives a sum of money from an investor and agrees to pay interest payments known as coupons. Please note the borrower is also known as the bond issuer, and the investor is known as the bond holder. Okay, the borrower is known as the bond issuer, and the investor is known as the bond holder. So the borrower, who is the bond issuer, the borrower has to repay the par value of the bond at maturity. So we have what we call the par value associated with the bond, and at maturity the borrower has to pay back this par value. So in between the borrower borrowing the money and paying back the loan, the borrower has to pay interest payments known as coupons. These are known as coupon payments on the amount that they borrowed. The par value is also known as the nominal value, and it's also known as the face value, right? So the par value is also known as the nominal value, and it can also be called the face value. Okay, so even though the investor has to wait until maturity to get their money back, right? But they can sell the bond before maturity. So the investor will have a certificate that confirms that the company has the investor's money. So that certificate is what we sometimes call a bond, right? That certificate is a certificate confirming that a company has the investor's money. So the investor might decide that they no longer want to wait until maturity, and they can take that certificate, sell it to someone else, and then that person gives them money, gives them a price, the price of the bond. And then the person they sell that certificate to, the person they sell the bond to, is the one who will now receive coupon payments from the company. And then at maturity, that person is the one who will be paid the par value. So you can sell a bond as an investor. You don't have to hold it until maturity if you decide you want to sell it. So before we look at calculating the price of a bond, you also have to know the relationship between bond prices and interest rates. Relationship between the price of a bond and interest rates. We also call interest rates the yield to maturity, right? So these are just market interest rates. So let's say an investor decides they want to sell a bond before maturity. You need to understand the relationship between the price they can sell the bond at and the current interest rates in the market, right? So there is an indirect relationship between the price of a bond and interest rates. So there's an indirect relationship or an inverse relationship between the price of a bond and interest rates. And what do we mean by that? We mean that as interest rates go up, and as market interest rates go up, the price of a bond goes down. And as interest rates go down, the price of a bond goes up. Okay, so if you're an investor and you've invested in a bond, when interest rates start going up, the price of your bond, meaning the price at which you can sell the bond for, will start going down. And inversely, when interest rates start going down in the market, the price at which you can sell a bond at will start going up. So there's an indirect inverse relationship between the price of a bond and interest rates, right? And they sometimes do ask about this. And lastly, before we look at calculations, there's also an important relationship between the coupon rate on a bond and the yield to maturity. Remember, a coupon rate is the interest rate that the borrower is paying on the bond. And we said they pay a coupon payment, and the coupon payment is based on what we call a coupon rate. So if a company borrows through a bond, they are going to pay a coupon payment, and that coupon payment is based on a coupon rate. So you also have to understand the relationship between a coupon rate and the yield to maturity on a bond. Okay, so what does this relationship say? This relationship says if the yield to maturity on a bond is higher than the coupon rate, then the price of the bond will be lower than the par value. This means if we have a bond and we look at its coupon rate and we compare the coupon rate of the bond with the yield to maturity of the bond, the yield to maturity is just another name for interest rates. So in other words, if the coupon rate on a bond is higher, if the yield to maturity on a bond, meaning if the interest rates in the market associated with the bond are higher than the coupon rate, then the price of the bond will be lower than the par value. Okay. And then secondly, if the yield to maturity, meaning the interest rate in the market associated with the bond is lower than the coupon rate, then the price of the bond will be higher than the par value, right? And lastly, if the yield to maturity on the bond is equal to the coupon rate, then the price of the bond will be equal to the par value. So this is just an important relationship that's sometimes asked in the exam. So you need to know it. You need to know the relationship between the coupon rate and the yield to maturity and how that affects the price of the bond and the par value on the bond. Okay, so it's an important relationship. Please make sure you understand this. Right, now let's get to how you can actually determine the price of a bond using a financial calculator. So on your financial calculator, FV represents the par value or the nominal value associated with the bond. N represents the term to maturity, it's usually in years. These are the number of years you have to wait as an investor until you get your money back. I over YR represents the yield to maturity. This is also sometimes just known as the interest rate, right? And PMT represents the coupon rate, right? So PMT represents the coupon payment. PMT represents the coupon payment, not the coupon. Okay, so it's actually the coupon payment, right? I've just corrected that. So PV is the price of the bond, and then we can get the coupon payment, this coupon payment I've been referring to, We can get this coupon payment by simply taking our par value. So this coupon payment, we can get it by simply taking our par value multiplied by the coupon rate. Okay, we can get this by simply taking our par value multiplied by the coupon rate. Okay, so you also need to be careful, just as we've been dealing with different types of compounding, like semi-annual compounding, quarterly compounding, and so forth. Coupon payments might sometimes happen more than annually. So the interest that's paid by a company or a borrower, the interest might sometimes be paid more than annually. Okay, so we also have to factor that in. Okay, so when that happens, we need to make some adjustments. When that happens, we need to make some adjustments to make sure that we get the right answers. Okay, so let's say interest payments are happening semi-annually. If interest payments are happening semi-annually, we need to divide PMT by 2. We need to multiply our N by 2, and we need to divide our yield to maturity by 2, our I over YR. If interest payments are happening monthly, we need to divide our PMT by 12, multiply N by 12, and divide our interest by 12. Quarterly, divide our PMT by 4, our N multiplied by 4, our I over YR divided by 4, right? So these are the inputs we have to put into our financial calculator when coupon payments are happening more than annually. However, when calculating PMT, N, or I over YR, let's say we're not calculating the price of the bond, but rather we're calculating one of these items. When we are calculating PMT, N, or 1 over YR, we need to make an opposite adjustment. We need to make an opposite adjustment, meaning if interest is compounded semi-annually, right, and we are calculating PMT, we need to remember to multiply the PMT by 2, right? Or let's say interest is compounded semi-annually, or coupon payments are happening semi-annually, and we're calculating N, we need to remember to divide the final answer of N by 2. So you see we're doing the opposite to what's written. Likewise, if we're calculating yield to maturity and it's semi-annually compounding, we need to remember to multiply the final answer by 2. So if we're calculating one of these items, we need to make the opposite adjustment. So that's important. So now let's just let's finish off this recording and this session by just looking at some examples to illustrate to you how this would actually work in reality. Okay, so here's the first example that I've put up. I just want us to work through this example quickly. Okay, so this example says a South African investor has purchased a 3-year bond, meaning a South African investor has lent someone money for 3 years, and they've lent that person money for 3 years at 1,000 rand. Under the agreement that the person will pay back 1,000 rand, pay each bond, pay each contract. So this investor might hold 50 of these contracts, right? Meaning that they are going to get 50,000 rand after 3 years, right? So the 1,000 par value is the amount that the investor agrees to pay back per contract, per bond. So a South African investor has purchased a 3-year bond with a 1,000 rand par value and an 8% semi-annual coupon. So this is the coupon rate. It tells us how much interest the borrower will be paying with a yield to maturity of 10%. So this is the current interest rate in the market. This is the market interest rate. And then they want us to determine the current price of the bond. Remember, we said if the yield to maturity, right, is greater than the coupon rate, it means the price of the bond will be less than the par value. Remember the theory that we just talked about right here, the relationship between the coupon rate and the yield to maturity. maturity is really important. So we can take our financial calculator. We can enter in 1,000 as our future value. That's the par value. We can say 8% times 1,000 divided by 2. We get 40 as our PMT. So you notice here we are dividing PMT by 2 because it's a semi-annual coupon paying bond. We multiply our number of years by 2 to get 6, and then we divide our yield to maturity by 2 to get 5. And then we input these items and we calculate the P. Maybe I can just illustrate that to you on the calculator, right? So we say 1,000 is our future value, and then 0.088% multiplied by 1,000 divided by 2. That gives us our PMT. So we put that 40 as our PMT. 3 by 2, that gives us N, the 6, and then the yield to maturity divided by 2. That gives us 5, and then PV we get 949.24. Okay, so that's how you would get the price of the bond. If it's monthly, you would remember to adjust by dividing by 12, multiplying by 12, dividing by 12, and so forth. Okay, let's look at example 2. This is slightly different. A bond manager considers buying a 5-year semi-annual bond with 1,000 Rand par value, 12% coupon rate, and is currently trading at 937. Which of the following is closest to the yield to maturity of this bond? So here we put 1,000 as our FV, that's the par value. It's a monthly, it's a semi-annual bond again. So we say 0.12, 12% times 1,000 divided by 2, giving us a PMT of 60. We say 5 times 2, giving us 10 because it's 5 years, so we multiply the years by 2. We put in our price. Remember, we always put in price as a PV as a negative, so that you don't get no solution. If you don't put PV as a negative, you get no solution. So we put PV as a negative, and then we calculate I over YR. The calculator gives us 6.89, right? But remember, we said that when we're calculating any of these items, we need to make opposite adjustments to what we usually make when they are inputs. Okay, so this 6.89%, it's a semi-annual yield to maturity. So we need to multiply it by 2 to change it into an annual yield to maturity. So that can be confusing for a lot of students, but it's important to remember that whenever you're calculating PMTN or I over YR yield to maturity, always remember to make the opposite adjustment, right, to these inputs that we put in when we are calculating, because 6.89% is a semi-annual yield to maturity. But what we want in the exam is an annual yield to maturity. So if you get 6.89%, this is 6.89% semi-annual yield to maturity. So you need to multiply it. So just remember this table. But remember, if you're calculating any of these items, make an opposite. This is really important. I can't emphasize how important this is. Make an opposite adjustment. Okay, please, it's extremely important, but we'll do more questions and you'll see that. So just to get you to be even more familiar with bond valuation practice questions, I'm just going to take you through some questions from assignment 1, semester 1, 2020. I think there are about 1, 2, 3, 4, 5 questions I'll take you through, and then after that I'll give you homework so that you can practice on these questions, right? So the first questions we'll look at are actually questions from assignment 2. Okay, that's my mistake there. I'll also fix it. Okay, so I was saying we want to look at some questions from the 2020 assignment 2 semester 1. So I'll take you through question 9, 10, 11, 12, and 13, and then I'll give you some homework. Okay, so let's start by looking at question 9. Question 9. So question 9 read that we had a company and they sorry, actually it's semester 2. This is actually semester 2. We should be semester 1. Okay, let me just confirm the question. Okay, we'll start with question 8. Yeah, question 8. So question 8 says that Inando Chicken Company has 2 bond issues currently outstanding and both sell for 1,140. The first issue has a coupon rate of 7.2% and 15 years to maturity. The second issue has an identical yield to maturity to the first bond, but only 10 years until maturity. Both issues pay interest annually. What is the annual interest payment on the second issue? So here they want us to determine the coupon payment of the second bond. Okay. So what you can do, you can list out the information of both bonds. The first bond, meaning the first issue of bonds, and the second issue of bonds. So we've been told both bonds have the same price, so it means their PV is both the same. But the first bond has a maturity of 15 years, whereas the second bond has a maturity of 10 years. The coupon payment on the first bond, we've been told it has a coupon rate of 7.2%. So we can get the coupon payment on the bond by saying 7.2% times the par value, giving us a PMT of 72. 1,000 is the future value, that's the FV, right? So we can input these items into our financial calculator to get a yield to maturity of 5.78 for the first bond. And then we've been told that both bonds have the same yield to maturity, right? So we can then take this yield to maturity of the first bond and use it as the yield to maturity of the second bond. And then we can input these items into our calculator and we get a PMT of 76.2. So please just try to do these calculations and see if you come to the same answer. So the idea here is that you're trying to use information from the first bond to get the yield to maturity. And then you will use that yield to maturity for the second bond so that you can get the PMT. And remember, when we're calculating PMT, the percentage we put here, we always put it as a decimal. It's 0.072 times 1,000 to give us our PMT. Can you put the recording on pause and try question 10? Just try to see if you can identify the FV, the PMT, the interest, and so forth, and then try to calculate the present value. And then when you're done with that calculation, put the recording on continue and then compare your answer with my answer. Remember, the interest rate is the yield to maturity. 13 is N, 20,000. Identify what the FV is, what the PV, PMT is, and so forth, and then calculate the price of the bond. Please try that, and then when you're done, put the recording on continue. Okay, so hopefully you got the answer there, right? You were supposed to take 13 as your N. You input that into the calculator. The bondholder will receive the investor, the bondholder, that's the investor, will be paid 20,000 Rand after 13 years. That's the par value. The PMT is 2,180. That's the coupon payment every year. The interest rate, that's the yield to maturity, is 9.35%. And then we calculate our PV, which is 22,278 and 20 cents. So for question 10, our answer is 22,278 and 20 cents. Okay, which is option 20, or which is option 3, sorry. Also, again, can you put the recording on pause? Try question 11, and then when you're done, press continue, and then we can compare what you've done with what I have. Okay, so hopefully you were able to do question 11 and hopefully you got 8.99%. In this case, remember the coupon payments are happening semi-annually. They pay interest semi-annually, so we need to remember to multiply n by 2, 15 by 2, those are our years, 1000 is the future value. Divide our yield to maturity by 2, 7.95% divided by 2. Our PV, that's the current price of the bond. We take that to be 1090 as PV, and then we calculate PMT. But remember, because it's semi-annual, we always need to make the opposite adjustment. So we need to then multiply this PMT by 2. Remember, if it's an input, we divide PMT, but if we're calculating it as our final answer, we multiply it. We always make the opposite adjustment. So in this case, we multiply it by 2 to get the annual PMT, and then to get the coupon rate, we take that PMT divided by our par value, 89.87 over 1000, and that gives us 0.0899, which is 8.99%. Okay. Again, can you put the recording on pause, and can you try question 12, and then when you're done, press continue, and then we can compare what you've done with what I have. Okay, so hopefully you were able to do that, and hopefully you got 2.01%. Again, we have semi-annual payments. It means our PMT, we say 0.08 times par value, 8% times par value divided by 2, giving us a PMT of 40. 1000 is our future value. Remember to always put your PV as a negative. The price, if you don't, you'll get no solution or error on your calculator, minus 1874. 8 by 2 for n, and then we get 1.01. And remember, we said if we're calculating interest or PMT or n, we always make the opposite adjustment to the final answer. So we multiply this by 2 and we get 2.01%. Lastly, can you try question 13? Put the recording on pause. Give this a try. See if you can identify everything you've been given. Input it into your calculator, and then let's check the answer you get. Okay, so hopefully you got 15.19 years. 1000 is our future value. 847, that's the price of the bond. We'll put that as a negative. 8% times 1000 giving us 80, that's our PMT. That's the coupon payment, right? Based on the coupon rates times par value. 10% is the yield to maturity, and we calculate n, which is 15.19 years. So those are some examples of questions you need to be familiar with when it comes to bond valuation. Okay, so I just want to give you some homework here so that you can practice on bond valuation questions. Please go through question 34 to 40 from May, June 2019, the multiple choice questions section. And then in the next session, I'll take you through these solutions, and we'll look at risk and return. We should be able to look at this in one session. And then I think we'll need 2 sessions to look at share valuation. So please go through this homework, and then I'll take you through that next time. So thank you for listening. I hope the recording has been helpful. As usual, if you have any queries, please feel free to let me know, and please keep practicing questions just so you keep fresh as we get closer to the exam. Thank you.